Good evening, everyone. Thanks for joining the session. I'll make sure the next 1 hour will be valuable. It will add a lot more insights about various option strategies. You can learn some new tips, techniques. So last 2 to 3 weeks, we discussed about what are option contracts. What do you mean by calls? What do you mean by puts? We also discussed about what is in the money, what is at the money, what is out of the money. We discussed about option Greeks, like what is delta, what is gamma, what is theta, right? What is vega, why it is important to know about all those things, right? Because as we discussed, right, delta shows us like what is the probability of success for that particular strike price. If we are getting it, is it 30%, 40%, 60%, 80%? Is it better to get a in the money call, at the money call, out of the money call? It all depends on, right? If we just follow alerts, alert might be for a generic member, but your portfolio might be completely different. You might be having a portfolio of a 200K. The alert might be for somebody with a 25K, right? So by knowing all these terms, all these concepts, you will be able to make much better decisions. You will be able to make take less risks and make better profits when we take time to learn all these concepts. I hope you remember, right? What is delta? What is gamma, theta, vega, right? We didn't discuss much about rho. It is basically just like delta is on the impact of price move. Gamma is on the right price move, but based on delta, gamma moves. Theta is based on the time decay. As we lose more and more time, the option premiums will be reduced. Vega is based on the volatility of the stock. If the stock is quickly moving up and down, we will be losing that option premiums. Then rho is based on the impact of interest rate changes. Again, we don't use rho much, but these delta, gamma, theta, vega, these are the most important things which we need to understand when we are buying option contracts. So we'll get on to the next concepts, right? I gave a quick reminder like what all we discussed in the last 2 to 3 weeks. So when to buy a long call, right? Most of the times, right, in alerts channels or most of us, we like to buy calls whenever we are bullish about a stock, right? It is a long call. That means you are not selling it, but you are buying a call. You are paying some premium and you want to, because you are bullish, you are thinking that, okay, this snow will go up in the next week, or you are thinking Zoom will go next week, or Tesla will move up tomorrow, and you are buying a call because based on your analysis or based on reading some news or based on following some alerts or based on one of your friends' recommendation, you are buying a call. That means you are paying a premium. You are getting into an agreement saying that I am okay to pay this price, but you have to sell this stock at so and so price. That is what you are entering. What is the typical duration? Generally, right? Again, we know, so we take the Friday lottos, all those things, but they are very, very risky. If you are if you are okay to take high risk, you can play the same day expiry trades, but the theta decay, right? The time decay will be huge. We discussed last week how the time decay, if you have 6 weeks, the decay will be very slow. But if it is a same day expiry, within few minutes, your premium will be burnt like anything. So if you have a high risk appetite, you can take those lottos, that to take minimal trades, right? For example, if I say that we have to use 2 to 3% on each trade, don't use your 2 to 3% on a lotto trade, right? It is like a lottery, right? We know what is the chances of winning a lottery. In the same way, lotto trade is for the same day expiry, you are assuming that that stock will move by so. For example, on Friday, we took Adobe puts. It moved nearly 90% up within 10-15 minutes. We took, I think, AVGO or something else. It moved up. Then we took, again, we took some call, but it did not move. So those are like lotteries, or those are like same day expiry is very, very risky. So don't try to put 2%, 3% in those lotto trades. Even the same week expiry, also try to limit the position size. But if it is next monthly, or if you have 2 or 3 weeks for the next monthly expiry, then you can take such type of trades with 3% position size. So the typical duration for long call is 2 days to 3 weeks. And what is the profit we can get? What is the potential? It can be unlimited. Right? There is no limit on a long call. If stock moves by $200, $300 suddenly, then you may make huge profits on that. The loss, the maximum loss as a buyer, if you are buying a call, the maximum loss is whatever amount you are paying for the call, that is the loss. Because you don't have any obligation to buy the stock at that price, whatever you agreed. You only have a right to buy, but you don't have obligation. So that's why generally we, instead of selling a call, generally we try to buy a call, because your risk is limited. You know what is the maximum you can lose. If stock is not moving as expected, you know that, okay, if I'm buying a option contract of $2, that means $200 is my loss for one contract. You know that 200 is the maximum loss if stock doesn't move, right? So basically the graph also shows the same thing, right? What is the break even, what is the maximum loss? So that is about a long call, and what type of things you need to remember when you are buying a long call. Make sure the open interest on that strike price, right? Whichever you are buying, at least 30 times of the number of contracts which you want to buy, right? For example, if you want to buy 10 contracts, the open interest should be minimum 300. Otherwise, what will happen is that there will be a huge bid and spread. Right? There is no liquidity. Basically, if the open interest is very, very low, then there may not be liquidity. The bid and ask might be too wide. You might be losing on such type of strike price. Right? Again, I hope you all remember about what is open interest. For example, right? Let us say I want to buy snow, right? I am expecting snow will move very well this week. If you see what is the open interest for this particular 157.5, it is only 35. For the 155, it is 310. Whereas for 162.5, there is a huge opening. That means there are a lot of people who are interested at 162.5 or 160. If I want to buy 10 contracts, I don't, right? I should not buy something where the open interest is less than 30 times, right? My minimum criteria should be 300 or more. The open interest should be more than 300 if I want to buy 10 contracts. Otherwise, we might be in a big loss, right? That is the first point we all need to remember. Whenever you want to buy, make sure the open interest is at least 30 times of the number of contracts that you are looking to trade. The second thing we all need to look is, if you're buying calls, right, we have something called as VIX, right? VIX basically, right? VIX is basically the volatility indicator, right? It shows like how volatile is the market, the entire market, how, if the volatility is high, your premiums can move up and down, and they can get burnt very quickly. Generally, if volatility is above 20 plus, that means there is a high volatility, right? If it is above 25, that means risk is getting more and more high. If it is above 30, then you should forget about calls. So looking at VIX is also very, very important when you are buying calls, right? If VIX is above 20, it is better to avoid calls, because generally the SPY can go down. If VIX is going up, your ES or SPY, NQ, there is a chance that all will come down, except you can buy UVXY calls. But other than that, if you are buying Tesla calls or NVIDIA calls or AMD calls or whatever it is, there is a high risk, right? I'm not saying that we will not make money. We may make money, but the risk is high if the VIX is above 20. You should not. If the VIX is below 20, it is good for buying calls. I hope you got it right. VIX is the volatility index. If volatility is high, your stocks can suddenly go up, suddenly they may fall, and we may lose all our premium with that theta decay, with that volatility, with the Vega, right? Theta, all those things will eat our premiums. But if the volatility is low, that means you have a low risk. Then trade stocks which you know better, because you will have more confidence when you are trading something like Nvidia or AMD or Tesla or Amazon, something which you know, you feel confident. You will not get panicked immediately. If you trade something which you never heard of, suddenly the stock goes by $1, you will get panic and you may sell off quickly without waiting for it for a reversal or anything. Then the length of the trade. Generally, if the call you are buying is 1 week or less, better you go with delta of 50 or right. Generally, right? Again, it depends from each one based on your right. It is better you buy something here, because where you make a lot of money, right? If the stock, if I am bullish about snow, if I buy something like 152.5 or 150 or 140, right, in the money calls, I have a higher percentage of success, right? This delta is nothing but what is the probability of you to make money. If I buy 140 call, the probability is nearly 72%. If I buy some call like 180 call, the probability is 16%. So buying something somewhere here, right, 152.5, one strike in the money, somewhere around 50 to 60 delta is a good practice if it is less than a week. If it is 1 to 3 weeks, then you better go with 60 to 65 delta. If it is more than a month, go with 70 to 75. So based on the expiry date, if it is 26th August, I may go somewhere here, 50, 54, 46. If it is right, if I am taking something like I am going with 16 September, where 120 or 140 has nearly 75% chances of success, 69% chances of success. So based on the duration you have available for the expiry, we can go with these deltas for a better success rate or for taking low risk. Then that is about calls, right? For the long calls, if you are just buying calls, these are some of the guidelines to follow for a low risk and a better probability of success. Then put, right? When do we put? When do we buy a put? Whenever we are bearish, when we think like, oh, this Piton stock, it doesn't, right? Earlier, everybody used to work from home. There was a lot of demand for all these Piton, right? People used, right? They were not able to go to any gym or anything. They were buying all these Piton machinery, and they were doing all the exercise, everything at homes. But now, again, all the gyms are open. So Piton is going down and down. So again, next week, Piton might go more down. So if you feel like some stock will go down, right? The same thing happened with Zoom. When COVID time, the stock went up 200%, 300%, because everybody started using Zoom for all their office work, for schools, everything. But now after COVID is done, everybody is going to offices, schools, then the Zoom stock value went down. So again, the earnings, we may not see a major guidance or something. So if you feel like Zoom will go down or Piton will go down, then basically what we do, we buy a put on that. And what is the duration? Again, 2 days to 3 weeks. We may get the lotos for the same day expiry, but it is only for just like buying a lottery. Don't buy more than 1 or 2 contracts, right? Just it is like throw away money. You are okay to completely throw away without even thinking for a minute. Only put that in those lotto trades. Max profit unlimited, because if the stock goes 100, 200, 300, 400% down, there is no limit for the profit you can make. The maximum loss, whatever amount you are paying for the put, whatever premium you are paying for the put, that is the maximum loss. So just like calls, same thing with puts also. Make sure when you are buying a put, you should have minimum 30 times of right, whatever you want to buy, you should have, right? Let us see Python, or let us see Zoom, right? I will, let us say now stock is around $100, but I want to buy a put for let us say $95, right? So if I, or let me say I want to buy for 93. If I want to buy 10 contracts, that means I am paying somewhere in between bid and ask for $4.10, $4.15. But what is the open interest is only 191. That means there is very, very low interest for this particular strike price. If I am buying 10 contracts, the open interest should be more than 30 times. If that is not there, then possibility of I may not have a, whenever I want to sell it, there may not be any buyers to buy that contract. There may be very less interest. You may have to sell at a lower price, right? Your bid and ask will be wide. We may lose a lot of money when there is no liquidity. For example, this one 90, right? There is a huge open interest. People are, right? A lot of people are thinking that the stock might come to around 90 by this time, right? If you see the overall, you have a huge open interest on 90. That means this is okay, right? If I want to buy a put rather than buying for 93 or 99, if I buy here, buy this one, there might be higher probability or higher liquidity, right? So that is first thing which you need to remember. It should be at least 30 times of whatever number of contracts you are buying, your open interest should be minimum 30 times of that. And VIX is above 20. Generally, if puts, that means bearish. When VIX is high, that means volatility is high, your stocks can drop. That's where you can make more money. So generally for buying puts, if VIX is above 20, that will give more possibility to make a lot more money. And again, trade stocks, which you know better, same thing, length of the trade based on if you are buying 1 week or less, try to see somewhere here where delta is 50, right, at the money, or one strike in the money, right? One strike in the money means, so for here, right, this is like one strike in the money. Call side, this is one strike. Two strikes means this is in the calls, this 98 is the two strikes in the money, whereas 101 is two strikes on the put side. So again, you look at the delta, based on that, you can take, based on the expiry dates, you can look at the delta, right? So that you are taking a lower risk. Then, right, this is generally what we do, right? Most of us, 90% of the traders who trade options, generally they buy a call or they buy a put, right? Whenever they are bullish, they buy a call. Whenever they are bearish, they buy a put. But one thing we all need to understand, in this agreement, right? You can be a buyer, you can be a seller. It is not that TD Ameritrade or brokerage platform is selling all these things. It is some other trading who is selling a call and you are buying it, or some other seller is selling a put, you are buying a put. It is all traders who are doing all these transactions. So because the risk is limited, you know what is the risk? Generally, we try to buy a call or buy a put because the risk is limited. You know that whatever premium you are paying, that is the only risk you have. That's why many will generally go with buying calls or buying puts. But we need to understand the concept that out of all these factors, right? When you see if price increases, it's okay, right? You will get the benefit with the delta and gamma. But if price is not increasing, stock is not moving up, or price is moving up, coming down, moving up, coming down, right? It is so volatile, or it is not moving up to 4 or 5 days, and then 6th day it is moving little up. So all these things are against to the buyer. Your theta, your time decay is against. Your vega, volatility, right? If stock is moving up and down, we know how choppy this market is. It suddenly moves up. Tesla suddenly moves up 50 points. Again, next day it suddenly goes down. Or AMD or Nvidia, they move up, again they come down. Right? We are seeing a lot of stocks like that. Amazon, after split, it was moving up. It went to 100. Again, it came to 145. Again, it came to 140. So there is no proper direction in the market. When there is no proper direction, this theta, vega, all these things are playing against the buyer, right? If it is a bullish market or if it is a bearish market, all these things will help us, right? Because you have a proper direction. If you buy a call, right, we know 2020, 2021, whatever you buy, they used to completely follow technical analysis. They used to go to the next resistance. There might be some resistance there, little retracement. Again, the volume, it used to break that resistance, go to the next resistance, like that. It was, right, everybody made huge money in 2020, 2021, because the direction was purely one side, right? Bullish or bearish. But in 2022, especially from January, from right until nearly end of July or end of mid of July, the market is so choppy. You never know what will happen. Everything is driven by news, because of Ukraine-Russia war, because of inflation, because of so many factors. Market is moving up and down, up and down. So in such type of choppy environments, all these things are working against a buyer, right? Because if it goes up, then we can make a lot of money. But if things are not right, if stock price is staying there, or if stock price is going down, then basically seller is at the advantage, right? When you are buying something, right, what can happen to the stock? Either it can move up, it can just stay there, or it can move down. So out of three possibilities, as a buyer, you have only one way to make money. But as a seller, you have two ways to make money, because even if stock is not moving, right, as you remember, whatever premium we are not only paying just for the price, we are paying for the volatility, we are paying for the time value, we are paying for so many things. So if I am buying this 26th August call for 100 or some 102 or something, and if stock is just staying there, right, it is not going down, but if it is staying there, then seller is still at a profit, because he is making the time theta every day, some premium he is getting it because of the theta decay. If stock is just moving up and down without a proper direction, because of the implied volatility, he is making money. So seller is at an advantage in a choppy market, whereas buyer is an advantage, either it is a bullish market or bearish market. So, right, if I buy a call or buy a put, the only way to make money is if it either moves up or if it goes down, I can make money. Right? If I buy a call, stock should definitely move up. If I buy a put, stock should definitely go down. That is the only way to make money if it is not moving as expected. For example, I bought, right, let us take CRM example, right? Again, CRM is one more which I am expecting that we can see a good movement. So let us say I am expecting CRM will reach approximately 190 by next 2 to 3 days, right? We bought it on Friday. Within few minutes, we made 100% returns on CRM calls. We took a 182.5 call, and within few minutes, it immediately moved. So let us say I am buying a 190 call, right, where there is a huge open interest, right? If I want to buy 10 contracts, there is nearly 100 times of open interest. So it is a good indicator. And there are, right, lot of good news is around CRM. There is a lot of open interest. This side put, so also there should be volume, but it should not be too high than what I'm seeing here, that is also a good indicator. Then, as I explained in previous sessions, if you see, right, there is a lot of some calls and buys, right? If you see the overall, how many calls people are buying, how many puts people are buying. If you see the overall on Friday, there was a lot of volume on calls compared to puts, right? If you see 5,145 calls compared to 3,700 puts, there is nearly 46% bought with a 0 to 20 delta, 23% bought 21 to 40 delta. So there is a huge who are buying below, right, out of the money calls. That means they are expecting that this stock will move up. So there are a lot of positive indicators, and also, right, based on technical analysis, it broke the resistance and it is moving to the next support. So based on a lot of factors, right, based on the fundamentals, based on the possible earnings, based on the option flows, there is a lot of potential for CRM, unless, again, right, that is the disclaimer, unless we hear some bad news saying like again Ukraine Russia war or China Taiwan war, something like that. Otherwise, there is a huge potential for the stock to move to 190. So if I'm buying a 190, right, let us say I want to buy 2 contracts, right, because my investment is approximately $1,000 on any ticker I buy. So because the price is 4.5 and 4.35, that means in between, it approximately 4.2 is my price for each stock. That means $420 is for 1 contract. If I'm getting 2 contracts, it is approximately $840. So if I am buying 2 contracts, and if the stock is not moving to 190 by Friday, if it is not moving at all, then that entire $840 I am paying is loss, right? Instead of that, right, my investment, I am using a lot of investment and I am just going by one direction. I am just buying by paying $840 of this one, right? Even though I am very bullish. So when I'm very confident, I may just go with long calls. But when I am 60-40 or something, there is a concept called as vertical spreads, where you can buy a call, you can also sell a call, so that your investment will get reduced, right? Instead of paying $840, right? For example, I buy 190 call and I sell 195 call, because I am expecting that it will come up to 190, but it will not come up to 195, right? I can buy something. So what I will do, I will say buy, I will say a vertical. I am buying a vertical spread. What I am trying to do, I want to buy 2 contracts of 190 and I want to sell 2 contracts of 195. So what is my cost now? What is my net cost is only $1.5 or $1.54. If I just buy a 190 call, right? If I just buy a single, right, a long, my cost is approximately 4.35, or right, even if I try to negotiate, approximately 4.2, 4.25, right? So if I am buying 2 contracts, my investment is $840. Instead of that, what I am trying to do, with a lower investment, I am bullish and I am thinking that this stock will somewhere go up to 190, 191, 192, but it will not go to 195. So instead of buying directly a long call, I am buying a call and also I am selling a call at the same time. So now, instead of $840, what is your, right? What is your overall investment from $840? It is only $300 now, because you are selling, you are receiving the premium now. So if stock goes up to 190, but it is not going up to 195, then you can make money from here you can make money from here. Now, instead of just one way, you are making money in both the ways. One is you are reducing your investment. Instead of spending $840, you are only spending $300. That is the first advantage. Your investment got reduced. Second advantage, if stock goes up to 190 but not going above 195 by 26th August, then because what is that? By selling what you are saying, you are ready to sell the CRM stock at $195 to that person. If the stock is 193, why he will buy at 195? He will not buy. That means you got all this premium by selling that 195 call. And because stock is above 190, your premiums might have increased it to 100%, 200%. So you are making money on buying a call. You are making money on selling a call. Your investment got reduced from $800 to $300, which is nearly 60% of reduction in your investment. And your profit can be double. It can be on the call, on buying a call, and also on selling a call. Right? I hope it is clear for everyone. Right? Now let us look at what is a vertical spread. Vertical spread is by purchasing one call or put within a given month and selling a different strike call with the same expiration. What is the benefit? Your investment got low from $840. Now your investment is only $300 for 2 contracts for that CRM. And you are also collecting premium, right? We just saw an example, right? For CRM, 190 call, you buy 190 call and you sell 195 call for the same expiration. So what is the total cost? We already saw, right? How it will help us. Instead of $4.2 or $4.3, your cost reduced to 1.5, and your profit only, right? The risk is if the stock is moving huge, instead of moving up to between 190 to 195, if it stock moves to 200 or 205, then your profit potential got reduced because you are making good money on this, but you are also losing some money on this 195 because you sold a call. So these premiums will increase. So your profit potential gets reduced, but still, right? Your premiums, wherever you bought, this will keep on increasing. This also will keep on increasing. So because this, if the stock is moving above 195, then your profit might get reduced. But if stock stays between 190 and 195, you are making money from the selling a call, you are making money from buying a call. In both the ways, you can make a lot of money with a lower investment. Only when stock is so bullish and moving so high, then your profit gets reduced, right? Again, it is not a loss if it is too bullish. Only thing is, if you just bought only a long call, and if it is moving 200, 205, your profits might be much more higher. But again, if you want to take low risk with a low investment, this is one of the, right? Because with a long call, if it doesn't go, your entire $840 is becoming zero. But here, by buying a call and selling a call, instead of 800, you are only losing $300, even if stock doesn't move, right? Because you already collected the premiums. That is the advantage with vertical spreads, right? When do we use this strategy? When you are bullish and you want to reduce your investment, you want to lower the cost, and you want a defined risk position. When you are going with single, right, naked calls or naked puts, that means you don't have any coverage. Just if it goes up, you make money. Otherwise, you are completely losing it. But here you have a defined risk position. And when you feel volatility is low, right, below 50% is ideal, right? Again, you know where to see the volatility, right? For example, here it is too high, right? Volatility is approximately 84.65. Here it may not be that much appropriate because there is a possibility for this one to move even to 195, 200 also for CRM, right? Especially after earnings, there is a huge potential for CRM stock to move huge. where your profit can get reduced by using a vertical spread. But there might be another stock where you can, where your volatility is less than 50%. Such type of stocks or such type of contracts where your volatility is less than 50, the vertical spread will help you to reduce your investment and increase your profits in both the sides. By buying a call, you can make money, and also selling a call, you can make money. And where do you want the stock to finish at the expiration? You want the stock to be right above the short strike, right? For example, even if it comes to 195, right? Even if it comes to 195, you won't lose anything, right? You don't need it between 190 and 190, because even if it comes to 195, already because of theta decay, because of volatility, all those things, you already made all the money which you collected, right? All the premium you collected. So even if CRM comes to 195, you will not be at a risk. But if it goes to 200, 205, your profits might get reduced. Right? That is called a vertical call spread. The same way, right? Just like we do a call spread, in the same way, you can also do a put spread, right? For snow, we saw an example, right? For CRM, we saw, right? Let us look at snow. Again, it is 142%, right? The volatility is much more higher. So I don't think even for snow also, vertical spread may not be ideal, but let us see AFRM. AFRM is 235%. That means there is a lot more volatility. There is a possibility that this stock can move a lot more higher. SQ is also 87%. Let's take something like LLY. Right, okay, LLY, the volatility is approximately 37%, right? So I see that there is a huge volume somewhere here. For example, I want to do for 16 September. I see that there is a huge open interest at 340. And then there is very, right, if you see 360, the open interest is very low. So this might be a good candidate. Your volatility is less than 50%, right? It is only 31%. That means there is not too much of volatility. The stock cannot suddenly move 20, 30 points. So what I can do here, I can just do, right? For example, I want to buy 340 call. Right, I can do a buy vertical. So 340 and 350, or 340 and 360. Right? There is a possibility that you will make money on the call side. You will make money by buying a call, by selling a call, because volatility is less. There is a huge open interest volume, and the stock seems to touch somewhere around 340 before 16 September. But the stock will not, right? The possibility of moving above 360 is less. So you are buying a 340 call, selling a 360 call. Your investment from $800, right? I am just taking two contracts as an example. From $800, your investment is getting reduced to somewhere around $600, or right, because you are paying approximately $4, you are receiving $1. That means your net investment is only $3 per stock. For two contracts, it is $600. From 800, your investment got reduced to 600. But if stock moves to somewhere around anywhere above 340 and up to 360, you are making profits on both the sides. By selling the call, by buying the call, you are making double the profits. Your risk got reduced. Your profits, now you have both the ways. It increases or it is below 360, you have one way to make money. If it is above 340, you have one way to make money. So that is right. That's what you need to remember. It is always better to see where volatility is below 50. Vertical spreads is a good candidate. So in the same way, right? Just like we buy calls, we can do same thing on the put side also. You can buy a put and also you can sell a put, right? For example, let me take, right? Let us take Zoom example. If I am thinking that Zoom will go down, right? I feel like if I buy this 90 put, my investment is nearly $5 for one contract, right? 5 means $500 for one contract. I feel like if from 100, it will go up to 90, but it may not go to 80, right? It will go up to 90 or maybe 85, but it will not go below 80. What I can do, I can again do the same thing by vertical, and you are buying 2 puts and selling 2 puts. So my investment, right? You are paying 90 cents, or you are paying some premium for buying a 90 put, and you are collecting premiums for 85 put. So your overall investment became $150. So if you just buy a put, your investment is $500. By buying a put and also selling a put, right? Why to sell? Because based on your analysis, the stock may go up from now it is approximately $100. Even after earnings, you are assuming that it may go somewhere 85 or something, 15% down. So instead of investing entire $1,000 on 90 put, you are only investing so 150. So you can make more money with a low risk, with a low investment. That is the advantage of vertical spreads, where you are buying a call and selling a call for the same expiry, or you are buying a put and you are selling a put for the same expiry. They are called as debit spreads. And right. So I hope everyone got it, right? What is the advantage? Your investment got reduced, your risk got reduced. You have 2 ways to make money. If it goes to 90, but less than 80, if it is not going less than 80, you are making a lot more profit. Even if it goes less than 80 also, you can make profit. Only thing is your profit might get limited, because right, these premiums are also increasing. So your profits might get little reduced, but still you are making good profits, even if it goes below 80 also, because these premiums will increase more and more. You already got a 90 put, you are selling a 80 put. So this also will increase, this also will increase. But if it is staying between these two, or between 90 to 80, then you have double the profit. So you are making money in both the ways. So that is the advantage of these vertical spreads. With the, instead of just buying a long call or a long put, by buying a call and selling a call, or buying a put and also selling a put, we can make money with a low investment, with a low risk, compared to just buying a naked call or naked put. So for example, if you see, right, we have analyst called PB, right? He generally gives this type of vertical spreads, right? For example, VRTX 290 call by 300 call. That means he's buying a 290 and selling a 300 call. AMD or Ulta 400 call, 420 call, or Baidu 140 call, 150 call. So your investment is getting reduced, and also, right, your overall profit also can increase if the stock is up to that point. So, right, that's what I wanted to explain about these debit spreads. And there is one more strategy called credit spreads, which has less risk and more profit potential. right? With a lower risk, we can make, or the probability of success is much more compared to debit spreads, right? With long calls, long puts, your risk is very high. With debit spreads, your risk got reduced. With credit spreads, your risk gets reduced much more, right? Which we'll be discussing in the next session on credit spreads, how to do credit spreads, how they are different compared to debit spreads. But right, I told you, right, I'll be showing you some tickers which has a huge potential this week. Right, we'll discuss about. Uh, right, these are some of the earnings in the coming week. Right, Nvidia, Zoom, Macy's, CRM, XP, Python, JD, Snow, PanW, Dollar Tree. Then these are, right, what is the estimates for the EPS, what is the estimate for revenue, what is their option flow. So based on so many factors, right, there are a lot of factors we need to consider before buying or selling a call. Or and this is, right, for example, this is for Snow. If you see for Snow, we are, right, we are close to the support. We are at approximately 150, 154 or somewhere, right? Your next support is at 161, 168, 179. Your RSI is, right, very low, right? It is oversold. So your volumes are increasing. You are, right? So again, if you go back, your what is for Snow, the estimate is 0.02, but as per Earnings Whisper, right, which is one of the top companies for these earning calls, they are predicting 0.03. So there is a lot of positive indicators for Snow. If you see the news, so overall, Snowflake remains the strongest overall data platform. If you see the enlist upgrades, there are a lot of good news around Snow, right? That is one factor. Then you see the option flow, 20,329 calls, whereas only 16,000 puts. You have a lot of, right, below 40. That means out of the money calls, there are more than 70, approximately 70%, 75%. That means a lot of investors, hedge funds are predicting that this stock will move high. And if you see the option volume, right, open interest, if you see, people are predicting it can go to 162.5, 165, even 175. There is a huge open interest. But again, as you go more farther and farther, your probability of success goes down, right? So if I want to go with 26th August, right? If I want to take a high risk, I will go with somewhere 165. 165 call. There is a huge volatility, right? Implied volatility, 142%. So this may not be good for vertical spread. But if I want to, right, I see there is a lot of bullish indicators. It is above the support, right? It already broke the resistance. It is above the support. A lot of fundamentally good news. There is a lot of positive things about the earnings, that we may get a better earnings. There's a lot of, right, if you see on the put side and this side, your open interest is huge on the calls compared to the puts. That means a lot of investors, a lot of hedge funds invested are expecting that this will move. So if I want to take a risk, I will go with 162.5 or 165. And if you look at 16 September, right, instead of, because if time is less, your theta decay, your time value, it will eat your premiums. If tomorrow, if it is not moving, your premiums will be reduced by some X amount. But if you take 16 September, right, you have a huge premiums, right? 1610 for 160, 1346 open interest, 1233. So somewhere around 160 or 165, you might be paying little more higher premiums, but you have more time. So your theta decay will be less, and you can, right, even though if it doesn't move in next 2-3 days, you have a lot more time and stock can move. So with a low risk appetite, you want to take a low risk, go with I'll go with 16 September, somewhere around for 160 or 165 call. If I have a high risk appetite, I will go with 162.5 or right. Yeah, approximately 162.5. Or again, as I told you, if you have a high so you know, right, the possibility of success is more as you buy more in the money calls. So I can also go with right where there is a high open interest, somewhere here 197 for this 150 call, there is a high open interest. I may even go with this if I have a right, but again the open interest is not so much, so I better go with 162.5 or 165 for snow. Right, that is right, either 26th August or 16 September, because of technical analysis, all the catalysts associated to it, because of the estimates for the earnings guidance, because of all these reasons, I am bullish on snow. Right. The next one, let us look into Salesforce. Right. Again, CRM, it got its earnings. Right. The estimate is 1.02. The estimate of revenue is 7.7 billion. The EPS is 1.06. There is a lot of contracts of 190 call expiring on September 16. So there's, again, you should not, right? There should be good amount of volume on calls and puts. It's not that only calls you should see volume. Having volume on both the sides is also a very good indicator. But if you see more volume on calls and some volume on puts, that's a good indicator. So the next ticker, right? One is snow, where we are very bullish, and second one is CRM, where right this 190 call seems right. If I have a high risk appetite, I will go with 190 call. Again, if you see the news, fundamentals, everything based on that, 190 call looks good for 26th August. Or if I have a low risk appetite, I am okay with small profits, but I don't want to take huge risk, I will go with 16 September. I will pay little more premium, but I will go with 190 call of 16 September. So I have more time. My theta decay will be small, and I am giving more time for the stock to go up. So, right, 190 call for 16 September or 190 call for 26th August based on my risk profile. Then what else? So, yeah, right, again, AFRM is another one, right? Again, what are the reasons? As I mentioned, we are looking whether it is close to the support. We are looking what are the various catalysts, what are the news associated to it. We are looking at the option flows. We are looking at, right, what is the overall, right, in the market, whether they are buying calls or they are buying puts. What is the overall tendency or overall market sentiment. So AFRM, right, little risky compared to the other two, CRM and snow, because if you see the calls and puts are nearly 50%, right, 51,165 calls. It is on last Friday. And what is the implied volatility is nearly 137. So huge, it can move to approximately $37, $38, right? If you see here, it shows that there is a possibility of the stock moving by $7, $6.79 in the next week. The implied volatility percentage is 235%. That means if we buy something like a 32 call, if stock moves to 37, 38, there is a huge profit, but also there is a risk, right? It is plus or minus. The stock can also go to 26 or 27, but again, comparing with a lot of factors, I feel like AFRM has a potential to move to 30, 37 to 38 in the next week. But this is more risky compared to CRM and SNO. Right, AFRM is our next one, where we are bullish. Then we have JD. Right, if you look at JD, again, you can see huge volumes, huge option flow. Again, look at the news, right? Again, it was beaten down, and JD is another one. Again, right? If you have a high risk tolerance, going with 26th August, where you make more returns, or if you have a low risk tolerance, go with 16 September, go with something like where you have a huge open interest close to right, somewhere around 56.26 or somewhere around here. So these are the 4 tickers, right? The first one is SNO, CRM, AFRM, and JD. These are the 4 which seems to be bullish. The first 2 are right with 90% confidence, and JD and AFRM are like with 75 to 80% confidence that these tickers can move in next 2 to 3 days before their earnings. And always before earnings, try to take as much as profits. Maybe you can keep 1 or 2, because it is like it can move so huge, or it can also go down if their guidance is bad, right? It is not only based on how much they made, it is based on their future guidance, what they are trying to do in the next 3 months. What are their plans? Are they trying to expand? Are they trying to do something else? Based on that future guidance, the price can move up, even though they may not meet the expected revenues. The stock can still go high based on the guidance. So it is all based on, so it is like either you make huge or you may lose huge. You have only 2 options. So that's why it is like a lottery. So don't leave a lot of contracts open for earnings. Try to take as much 80% profits before earnings, and then maybe keep 1 or 2, right, which you are okay to lose. It may become 0. Based on your risk appetite, you can leave 2 contracts, 3 contracts, which are like free contracts. Already you took back all your capital, all your profits, and whatever is remaining, you can keep for the earnings, so that if guidance is good, then stock can move 10, 12 points for something like AFRM or JD. Stock can move 20, 30 points for something like SNO, right, or CRM, right? I am expecting CRM, right? Salesforce is getting more and more clients. So especially Salesforce and also SNO, I am expecting a good guidance for AFRM JD. So it is like 75 to 80% chances will make profits. Again, all this based on there should not be any fundamentally something strong like right, some war news or something else, something happening to president, or then all this analysis will get invalidated if such type of events happen. Otherwise, if everything stays normal, there are no such type of war news or no new viruses, new variants, new monkeypox cases going up suddenly by 10-15% up. Otherwise, these 4, right, CRM, SNO, AFRM, and JD, based on lot of factors, based on looking at the earning predictions, based on looking at the option flows, looking at the fundamentals, looking at the technicals. These are the 4 tickers which we are predicting, and we will be sharing an update on a daily basis, right? And again, it is not that tomorrow morning we have to go and jump on these calls, right? Because there is always a support and resistance points. We need to wait patiently for them to come to a support point and buy them, right? It is not that if it is somewhere in between support and resistance, if we buy them, again, the stock can come back, retrace to support, and again, it may move up. So please don't, right, immediately tomorrow morning go and try to buy all these calls. Wait, right? If you have that technical analysis knowledge, or right, I'll try to, right, we are sharing some tickers on the US equities channel. So try to wait for that point where, so you can get a better premium. Otherwise, if you buy tomorrow morning, you might be paying much higher premiums. If you wait for them to come to a support point, then you will be paying lower premiums. So your profits, you will have a chance of making better profits compared to buying with a FOMO, right? So again, I repeat, take smaller, right? Don't try to take huge positions. Always maintain 2 to 3% maximum. And again, if you are new to these sessions, take on paper trading so that you get confidence, right? Once you see that, okay, this analysis is working fine, then you can take on your actual accounts. But until that, you can take on your paper trading so that you also get practice, right? So what today we covered on all the right. We just I reminded about all the basics. We discussed like why selling is also right. Not only just buying calls, buying puts. As a seller, you have more chances to make money, but you have a obligation to sell or buy stocks at a certain price. So that's why that vertical spread is a concept where you are buying and also selling with a lower risk, with a lower investment. We can make more money where the volatility is low. And we also discussed about various tickers, which has a huge potential to make a good move in the next week. CRM, SNOW, AFRM, and JD, right? With that, thanks everyone for joining in, and have a great week, and wish everyone all the best. Right, we'll be updating you on US equities and other channels. Thank you. Thanks for taking time, and we'll talk on the next. Again, there are a lot of things, right? Once we get all this knowledge, instead of directly jumping with a FOMO, it will start making sense, right? We'll look into credit spreads. We'll look into some scanners, how to do option scanners in Thinkorswim, how to do scanners in Finviz, how to do right, how to use option flows as an advantage. You see suddenly a 2 million, 3 million contracts. How we can take that advantage and buy immediately some calls or puts, and then you can quickly make some money. So there are a lot of techniques involved. We'll be doing more and more sessions so that you can take more informed decisions, and you can reduce the risk, right? There is always risk, right? I'm not saying that will 100%, right? No analyst or no one can give 100% success, but if we can make 80%, 75 to 80% also with a proper position size, definitely we can be making good side income with trading, right? Again, I know that maintaining that emotions for analysts or for anyone, it is difficult, but as everybody, right, just like doctors in trading also, we all start with mistakes, we lose money, then we understand, right, okay, what mistakes we did, why we failed, why we lost money. Then we'll slowly start correcting those and then get back all those losses back into the account, right? It is common for everyone to make mistakes, common for everyone to right, use their emotions, do panic buying, panic selling, or doing without understanding what they are doing. But when we spend some, right, we spent years together to make a 50K, 70K per annum. If we can spend few hours, right, maybe 20 hours, and try to understand all these things, there is definitely good money involved in trading. So please take time, understand the concepts, understand the sessions, right, before investing your hard-earned money. Right, with that, thanks everyone. Good night, and talk to you next week.